Welcome back to Business Week here on Arise News. This week, Nigerian investors experienced what can only be described as a roller coaster ride that tested nerves, shook portfolios, and ultimately revealed just how sensitive our capital markets have become to policy signals from Abuja. On Tuesday, November 11, the Nigeria Exchange suffered its steepest single-day decline in 15 years, a staggering 5% plunge that wiped over $3 billion in investor wealth in a matter of hours. Blue-chip giants like Dangote Cement, MTN Nigeria, and Boa Cement all hit their 10% loss limits. But just as dramatically, by Wednesday, the market staged its biggest rally in nearly 2 years, recovering 2.9% after authorities softened their stance on a controversial capital gains tax proposal. The whiplash didn't stop there. By Thursday, we'd seen another trillion naira added back to market capitalization. And yet, just 2 weeks ago, we were celebrating the NGX's remarkable 45% year-to-date gains, one of Africa's best performing in 2025. So what actually happened? Was this simply about a tax policy reversal, or are there deeper structural vulnerabilities at play? How much of this was foreign versus domestic institutional repositioning? And critically, what does this week tell us about the resilience of Nigeria's markets? Well, to join me to unpack this complexity is none other than the gold man himself. I'm joined by Arnold Dublin-Green, the CEO and Managing Director of RC Asset Management at Renaissance Capital. Welcome to the show.
Thanks for having me.
Great to see you. So the question I have is, was this an orderly sell-off, or are we witnessing something a bit more complex? And who was selling and why were they really selling? You manage their books, some of these people. So tell us.
So it was a protest sell-off and some profit taking.
Okay.
Right. Protesting in terms of just a kickback against capital gains tax and the announcement of capital gains tax, 25% capital gains tax. To answer your last question first, it was mainly institutional.
Okay.
Right. And you can tell this by looking at the volumes. You had a volume on Tuesday, you had a volume of about $20 million go through the markets. We're talking about a market that has averaged about $9 million every day this year. And normally when you have a sell-off with low volumes, you can stay relatively calm. But when you see a sell-off with high volumes, you know, okay, this is a panic. And the panic is anti-CGT, just against the capital gains tax.
Right. So it's interesting because if this is specifically about capital gains tax versus Nigeria's tax reforms, because we've been celebrating that in recent times,
yes,
right?
Yes.
So you're telling me that this sell-off, driven by institutional investors, was because they didn't like the introduction of this 30% capital gains tax, and there's nothing else that was going on here. Yeah,
so the issue with the capital gains tax, and I can start with this, is you are taxing a segment that has minimal participation, right? So if you look at the asset management industry, equity markets hold about 1% or less, under 1% of the assets under management, right? So you are increasing the tax burden in a segment that is already quite fragile and thin, right? So on the one hand, you have Nigerian investors who are slowly returning, the confidence in the equity markets is slowly returning. And then on the other hand, you have foreign portfolio investors who, let's not forget, a few years ago, Nigeria got downgraded and removed from indices like Barclays and Morgan Stanley. So there's still the sort of wishy-washy view on Nigerian equity markets. There's still a bit of uncertainty, and then you're increasing the tax burden in this segment. So naturally, it's going to be a pushback against this.
Yeah. Okay. So then we went from Tuesday to Wednesday, and we saw this recovery.
Yes.
So if we're saying this was down to tax, then the recovery was as a result of statements made by the finance minister, clarification, the plan to review, as opposed to maybe people just seeing attractive entry points after the initial sell-off. How would you then read the recovery versus the initial sell-off?
So it's twofold, right? So I know the tax consultants, Mr. Taiwo, clarified, but the bounce back wasn't based on a clarification.
It was based on the finance minister's statements,
yes,
right?
He alluded to the fact that they will review the capital gains tax. So it's that statement as well as some bargain hunting, right? So if you see your favorite stocks, you see GTCO, you think GTCO is 120 naira stock and it's trading at 75 naira. You think Zenith is an 80 naira stock trading at 55 naira, 52 naira. Naturally, you'd want to come in because you still think that there's still value. Because if you remember, the fundamentals hasn't changed. Our macro story hasn't changed. There's still macro improvements, affects liquidity, and inflation's going lower. It's just the tax issue, right? And no one knows how to price this
tax issue.
Yes.
And then it's interesting because the statement from the finance minister was a review. He didn't come out to explicitly say we're tanking this proposal altogether.
No, it was a review.
Right?
Yeah.
So it's interesting. Anyway, let's look at the dynamics of the actual selling.
Okay.
You know, only 4 stocks on Tuesday closed in green.
Yeah.
You know, just 4 stocks and hardly any blue chips, right?
Yeah.
I mean, they're not really blue chips. So tell us about that dynamic. You know, the stock market has gained almost 50% year to date. So in terms of the institutional makeup versus domestic investors versus portfolio investors, what does that tell us about how they think about their strategies or how you think about your strategy when you're advising them?
Yeah, so it's the liquid stocks, right? The liquid stocks move, and the liquid stocks, you go into liquid stocks also because you know you can easily get out if anything goes bad, right? So unfortunately, the liquid stocks, the stocks that we all go into, your GTCO, your Zenith, your big names, your blue chips, blue chips for us, and that's just what it is. Exactly, right. So that's how you manage your portfolio. You look at the stocks that are liquid enough for you to easily get in and out. You don't want to be stuck in a position when things go bad and you just can't sell your position. And fortunately or unfortunately, these are the same stocks that your foreign portfolio investors also look at. And that's why you saw the sell-off, because these are stocks that can easily go down. But also these stocks came back up the next day. Right?
They did. So it then raises in my mind this issue of the maturity of our market. You know, there was a phrase I used when I was introducing the segment. I talked about a whiplash because, if you're riding a car, that's what it feels like. It's like there's an initial impact and then there's a recovery, but you still suffer whiplash. So tell us about how mature is this market? Because it seems like it's largely concentrated, right, in a few big stocks that are liquid. What is the long-term outlook then if we have a market that is highly sensitive?
Yeah, so and that's going back to the capital gains tax issue. That's one of the problems, right? You have a market that isn't so liquid, it's quite shallow. And there's policy uncertainty and this is happening. So it just speaks volumes to the fact that our market is quite shallow, and we need to find a way to improve participation from investors and also improve participation from companies when it's a list. This year has been great for companies with rights issue and corporate actions. You have the likes of Presco raising money. You have the likes of Ella Lakes coming to the market to raise money. It's actually wonderful. And, I don't want to say that this capital gains tax isn't really helping that story, but in a sense it isn't, because, like I said, you already have a small participation of market participants in the market. And then this comes in and it can discourage, right? So what policymakers need to do is figure out a way to actually encourage participation in this market, so especially from locals. As much as I like the idea of foreign portfolio investors come in, they can easily exit, right, if anything happens. And as local investors, we know the story, we're close to the story, we have more confidence. So if you encourage local investors to get involved, institutions and retail investors, you have a stronger market with more liquidity.
Yeah, absolutely. And in fact, I think the percentage holdings foreign domestic has risen to about 20%.
Yes.
It was at about 11% or 10%. So we're gradually creeping back up to what pertained in the past, right?
Yes.
And that could be concerning, especially when you then have these types of policy pronouncements and foreign capital is extremely sensitive too. Now, the question then becomes, if a government, in terms of its reform policy, is forced to consider purely on the basis of investor reaction on the capital market, is there a fundamental structural problem in the Nigerian economy?
Fundamental structural problem in the economy?
Because the merits of the policy in and of itself should be under no doubt. So if you think CTG, capital gains increase, is a good thing for Nigeria's economy as a whole, then stick by your guns. As opposed to react on the basis of inflows coming out of the capital markets. I mean, do you think there might be an issue there? And the way I described it is where the markets are vetoing government policy, essentially shaping I don't know if you have a view on that. I know you don't look at the economics specifically, but I wondered whether you had a view.
So if I have to answer your question, on the macro side, I don't think there's anything wrong with Nigeria's macro. I think
so our fundamentals are sound.
Our fundamentals are sound and solid, and are getting better. I talked about inflation coming from high 30s to possibly high 16s, and when we get the announcement on Monday, FX liquidity, the fundamental story is still there. Right, but in my view, I like that the policymakers saw the market react and actually decided to take a step back or revisit things. And I think that's, in my view, is the equity markets, or the market's doing its job.
Fair enough.
As much as the market is forward-looking, so the equity markets rally because on a sentiment basis, it's, the economy is getting good, so the equity market is forward-looking, went ahead of it. But I actually love the idea of the market actually reacting to say, I don't like this idea of CGT, and then the policymaker saying, hold on a minute, let's think about this. So it's working.
Yeah. And interesting, because we've seen this, the NGX has been one of the best performing exchanges in Africa. We've seen the rally. If we didn't have a capital gains tax, giving the gains on the NGX, would we have seen a market correction anyway at this stage? Was there an overvaluation problem?
Okay, on the fundamental side, no valuation problem. Because companies are doing well, banks are reporting good earnings. Banks are still cheap on a price-to-book basis. Consumer names that had FX issues are deleveraging and trying to figure out their finance costs and their interest expense. So the rally makes sense, it made sense, and still makes sense, right? Because the economy is reflecting, the stocks are reflecting the economy and the future outlook of the economy. On a technical basis, nothing goes up in a straight line.
Sure, of
right?
course.
So sort of what goes up, so it has to come down. What's the capital gains tax announcement did was just add an extra catalyst. Just add an extra catalyst to this correction. So yes, the stocks rallied massively or aggressively. Fundamentally, it's too cheap. Nigeria is too cheap. Nigerian stocks is too cheap. But you just normally have this correction. Would we have seen a correction without CGT? Probably, but CGT was just an extra catalyst, a good catalyst.
So in terms of the advice you're giving to your clients now, are you telling them this is a great buying opportunity? Are you advising caution because of the policy sensitivity? How are you sort of positioning your strategy for the rest of the year?
So market hates uncertainty as well, right? So this policy also brings a level of uncertainty. And what I'm doing is the market has rallied over 40% year to date. It makes sense to take some profit, especially between now and the end of the year, where you have this uncertainty and there's going to be some more volatility. Because will they review, will they not review? Not necessarily cut your losses, take your profits, right? And then if you believe in the efficient market hypothesis, you know that from the 1st of January, whatever price you see is capital gains tax priced in already.
Yes.
Right.
Yes.
So what you might want to do, yes, you've seen a 40% return, and you don't know what's going to happen, and no one knows. So you're going to see this volatility between now and then. So take some profits and then come back on the 1st of January.
Okay,
that's what
interesting. We talked a lot about equities. Let's move on to some other assets. I want us to talk about, we've seen what's happened with crypto, Ethereum, the ETFs, and then we've seen what's also happened with gold. So how does that, in terms of overall strategy from a portfolio perspective, where are you? Are you going into more of those asset classes? The gold story is very interesting and bullish. Tell us about that.
Yeah, I mean, gold is good. The gold story has been good. Gold saw a pullback. Gold saw an aggressive rally in October, which worried worried me. And, going back to the whole idea of nothing goes up in a straight line. So my view on gold was, my view on gold is based on the fact that global central banks are buying gold aggressively and they are not price sensitive. I had a price target of 3,500 by the end of the year. It went past that target. So naturally you get worried that, okay, there should be a correction. And we saw that correction, right? Because gold went from 4,300 to 3,800 in a week, right? Which is also quite an aggressive sell-off. But I still think that where on the one hand, I don't know what the price of gold is. I still think gold is still a good investment, especially if you think that there's still a structural change coming in where global central banks are a little bit worried about the U.S. economy, US dollar, and where US stands in their reserve makeup, right? Global central banks are still buying gold. So based on that strong buying of gold by an entity that is not price sensitive, I still think gold is good. You have crypto on the other hand. In the medium to long term, I think crypto has become an interesting asset class. It's gone from pure speculation into an investment class on its own, and we're seeing that happen. We saw a pullback from 120,000 to 95,000 this week, again, which is natural, but also shows a global risk-off sentiment with everything going on around the world, and the US Fed being shaky about rate cuts, or some Fed governors being shaky about the rate cuts. But regardless, I still think that you will be remiss if you don't have these asset classes as part of your portfolio.
So if on the whole, for asset investors in Nigeria, equities still offer, in your mind, compelling sort of risk-adjusted returns.
Definitely.
Vis-a-vis some of these other asset classes, even despite the rally we've seen in gold and others. But looking at gold, CBN mentioned the fact that it had increased its reserves, holdings of gold had gone up by more than 100% from last year. I think we're at over 2 trillion Naira's worth. What does that say if the central bank itself is very bullish on gold? Is there anything else we can glean from that?
Yeah, definitely. I mean, so to go back to your first point about equity for Nigerian investors, 2026, equity is the good asset class. We're going to see fixed income yields and treasury bill yields go down. I think an interesting asset class that is emerging that Nigerian investors should start looking at is private credit.
Okay.
Right.
Yes.
So private credit is something that 2026 I think will be an important part of a portfolio makeup because it gives you an opportunity to still get that yield, almost the same yield as you were getting on government bonds and treasury bills this year. Also an equity risk as well, so you have a nice strong upside.
And so in terms of private credit, you know, sometimes when we finance and investment, people talk finance. Private credit is an asset class. It mirrors debt, but not similar to bank debt. Right? So the model is pretty much like private equity, but the financial product is debt.
Exactly. And that's what
and
it
you
is.
get regular distributions, the same you would get with interest on a loan.
Exactly. So, and you have a higher yield because you're lending to actual companies, a higher risk than the government risk, but it's going to be a higher.
And it's
higher
not
yield
as collateralized in terms of securing the actual credit to the companies. In terms of collateral requirements, they're not as rigorous as you would.
But it depends on the lenders. Some lenders are still quite hectic. Because they need to protect their downside. Because they also need to protect the investors. But it's for a business going for private credit over a bank, it's almost like a no-brainer. And for an investor, you get the high yield. And then going back into Nigeria's central bank buying gold, yes, definitely. Although I think that gold makes up about 4% of Nigeria's reserve, which I think is still quite small, because globally banks are averaging between 25 and 30%. You have the Bank of Poland, that's 30%. You have Ghana.
So gold is about 4% for Nigeria.
Yeah, gold is about 4%. So you have Ghana, that's almost 40%.
I mean, they produce gold, right?
Well, we can do a better job.
They're a big exporter of gold, but continue.
Yes. So the Nigerian central bank looking at gold as for diversification of its reserves is also a good wake-up call for the rest of us to also do the same with our portfolio.
Okay, overall, I mean, we've said a lot. Is there anything else that is interesting in terms of what you're seeing in the investment space, wealth management, asset management, that you think Nigerian investors should not overlook in terms of their portfolio strategies or thinking of where to put their wealth?
Sure. So my big take is for 2026, I think the two most important asset classes will be equity and private credits.
Okay, equity and private credit.
Yeah. So regardless of this capital gains tax, you're still getting some good upside in equities.
And are we seeing private credit really growing in the Nigerian market as opposed to globally? Because I know globally it's been a big market, even though we've seen some interesting blow-ups and defaults. But
yes. So I mean, the blow-ups is it was too much liquidity, right? So much liquidity. Some investors, unfortunately, didn't do their homework properly, which happens, right? When there's a lot of money, it's burning a hole in your pockets. You need to let it go. But it's interesting that you're seeing global private credits, West developed market private credits blow out, and it's in emerging markets and frontier private credits increase. Right. And you're seeing it in the BlackRocks are coming through, the BlackRocks and Blackstones are coming through proxy asset managers on the continent to come into the private credit space. So the global asset managers are looking at African private credit space and saying,
and do you think this is something the pension funds, institutional domestic investors here would sort of bite? Because we've also seen some slight revisions in allocation thresholds, trying to open them more to alternative asset classes.
Yes, definitely, because you're seeing pension funds request for this asset class, and you're seeing asset managers launch infrastructure funds, which is in a way a kind of private credit, but focus on infrastructure. But now you're seeing other asset managers now launch private credit products. So yes, definitely.
Fantastic. Thank you so much. Sir Arnold, thanks for coming on the show to give us the lowdown about global equities and global markets in general. Well, that's all we have time for on Business Week. I'm Rolake Akinkunmi Filani. Let's continue the conversation on X. Do have a lovely rest of the weekend.